Hi, it's Keith. Today I've got an update on my small account strategy, and this is one that I continue to devote time and effort to. It's I think an important one. I see too often people trying to sort of take a strategy that really is designed or built for a larger account and try to run it with just limited capital, and I don't think that's going to end well. I think having something like this that's sort of purpose built for a small account, I think it has a place. Even for myself, to just, if you're experimenting with bots like I am, and you don't want to devote a lot of capital while you're learning, to have something that you can run that's kind of safe for a small account and doesn't put too much capital at risk. In this case, I've got $2,000. These are running in a live account, so that's my allocation is just $2,000. And max risk at any time, I think, is around $650. I don't know if I've seen it go much beyond that. Again, that's just basically a calculation of, what our position size are. And again, these are all sort of carefully selected symbols that have sort of a price that, the stock is trading around sort of, between $20 and $50 or something like that. And on average, our risk is probably, I think it's, no more than $80, probably on average, looks like about 70. Yeah, here we got 9 positions open to, less than, around $600 in risk. So again, one more position, we're going to probably put us, probably about $700 in risk at any one time, right? So, I think it has a purpose. It has a place. It's designed to be relatively diversified. Again, all these symbols are carefully selected to be, represent sort of different markets that may perform differently at different times. And all again chosen for their liquidity. They all have sort of liquid weekly options, which is kind of important for options trading, of course. So I'm kind of committed to this one. I think it's a good strategy. I'm happy with the performance that I'm seeing. It kind of meets my criteria. Again, people will look at this and say, 6%. What's the S&P done over that same time? Yeah, you've got near 20% drawdown, but all of these things really look fine to me. I mean, if we just actually look at it, it looks like it's hitting higher highs. I mean, this is a pretty high high here we hit, and we exceeded that high, right, following that this big drawdown here. And this here is the 18.8. I've also calculated, we've got a drawdown. So from April 8th, I guess April 9th to April 17th, that was 18.1. Here we had an 18.8% drawdown, May 20th to June 13th, and right now we're currently drawn down about 13%. So, again, that drawdown is configurable, right? Just change your allocation if you can't stomach that amount of drawdown, then you just need to allocate more capital. The fact that I'm seeing higher highs is giving me confidence that I think this will perform well over time. What I'm not really pleased with is just looking at the positions it's opening. I just believe some of these positions it really should have never gotten into. Particularly FXI has been a loser. We've got a position open in FXI right now. It's kind of gone against us, and we just look at the chart of FXI. I mean, it's just going sideways. There's really no uptrend there. It's really, that's all the way back to May 17th that it's kind of been in a downtrend, so no reason why we should be entering a position in FXI. So some work needs to be, some enhancement, I guess, to the indicator is required here, and that will be the focus of my improvements that are forthcoming. So stay tuned for that. I think also I wanted to just mention a change that I did make. So again, to start focusing on the indicator, I will be releasing an update to the community, just a kind of template change with the revisions that I've made recently. And mainly what I've changed is I had an issue with this bot a few months ago where I got assigned on one of these positions. So that was something clearly that I wanted to address within the bot. I recorded a whole video about that process, so you can see. I mean, the outcome from a financial perspective wasn't a major impact. Well within the kind of risk tolerance of this particular strategy. It's just the inconvenience of it, and I've now realized actually in testing that change that failure to address that risk of assignment also led to sort of other downstream failures as well. So a lot of times when you have a problem, your strategy isn't working, or you're not able to exit a position, or you're seeing these large losses. Sometimes it's a failure upstream that's kind of led to that. And that's sort of what I've uncovered here. So I'll be releasing those changes again. It actually addresses the risk of assignment. How I've done that, we just look at maybe one of these positions here. Bank of America, here's one that's a pretty major loss here. Our max risk here is $65. We exited this at 63, so pretty much near our max loss. Again, this is in my live account, so this is all real data. We can see actually where we got filled at here. Filled out in the mid price, but a very wide bid-ask spread. So again, that's something that's expected when we're exiting this way. How I'm actually exiting, the rules that I've implemented is just going off a delta. Let's find that one. Yeah, so when we hit a 90 delta, that to me just says, okay, we're deep in the money, no chance that this position is going to recover. We have a significant risk of assignment at that point. Let's exit then. Why did I pick that over an 85 delta or some other number? I did some analysis of the position we got assigned on. It was beyond a 90 delta. And it had been sort of beyond 90 delta for several days leading up to where I actually got assigned. And I just thought that might be the right number. And I wanted to sort of maintain the original intended strategy. So this strategy, by design, has a 50% profit target and exits the week of expiration, so prior to the week of expiration. Right now, I think it was initially configured to close on the Monday that week of expiration. I've now changed it to close on the Friday before, again, just to avoid again more of these losing positions. The longer you hold them, the more problematic they're going to come. And we can see this one we exited here. I think. We still had 11 days or 11 calendar days, so that's still quite a significant amount of time left before expiration. So we've got more than a week, right? So we're we still exiting this position earlier than we would normally exit with our exit options, right? And you can see what happens. We get very illiquid positions when we get very deep in the money, and we're very close to expiration as well. So. Also, when I tested this, I did notice, obviously, there's some drawdown here. Some of this drawdown is, again, this, if we maybe look at the closed P&L, this is it dumping positions, right? This is it either getting close to expiration and having to exit positions, or that risk of assignment, one of those two reasons. And when it does that, usually they kind of come in bunches. It's the market has turned down, and now there's a bunch of losing positions that need to be exited. I was a little bit concerned about that when I first implemented the change. So I think I had my change going like end of May is when I had it in my live bot. I made kind of a silly mistake. I thought, well, the change is so simple. It's really just a few lines of code. It's not that complicated. Just put it on in my live account. I've fixed the problem there, and I'll just test it in my live account. What I realized was now I don't have the ability to see, well, what would have the outcome been if I had not made that change, right? We saw we had some drawdown. Well, what happened to those positions? Did they recover? Did they actually, was there any scenario where exiting a position because of risk of assignment, negatively impacted our P&L? Meaning, had we just held that position a little bit longer, would it have turned around and we would have, had a higher profit? Again, in that case, we exited with a pretty wide bid-ask spread. Maybe we should have waited, right? What would have happened? And I hadn't done that. I have since done that. I think back June 7th, I created two bots. One with that avoidance logic applied. So this is exiting positions, at that 90 delta. And then I've got one without it. And you can see here, actually, it may not be visible, but up until July 18th, so both these bots ran in parallel for a month and a half and had the exact same outcome. So again, it's not very frequent that we're going to have this risk of assignment. It wasn't until about a week or two ago that we had our kind of first example of a position that exited. If we go, this is the one that has the avoidance logic. And if we look at these positions exited, let's just pick this one here, one of the bigger ones here. This is the $58 loss. In this case, our max risk is $72. So again, not near our max loss, not significantly. We can see how many days left we had. Oh, this one actually, I've added the actual logic to check the days to expiration later. Where is it? We exited on July 19th, and this was on August 3rd. So yeah, we still had a couple of weeks left. We still had plenty of time left before expiration. This one we probably had a bit more time, therefore it looks like we got a much narrower bid-ask spread. Yeah, our bid-ask spread is reasonably close here, right? A bid of 76 cents, ask of 94. And again, as part of my testing, this is why I haven't released these changes yet, right? I made the change in my live account pretty much immediately. But then I realized, well, I need to evaluate the outcome of this, right? I need to evaluate how does this impact my P&L overall. Maybe it's a good idea that I run bots parallel to just see, does this have any sort of negative consequences? And also, my exits here, I've added a new exit strategy, so I need to make sure that the exit strategy used is efficient. Can I exit at a reasonable price? No craziness. I'm not doing anything silly like submitting market orders and getting filled worse than my max loss or anything like that. So all of that analysis is something that I've had to do before I would release this as a change. So that's why I've been kind of sitting on this change for a while. Unfortunately, people, maybe if they're still running the bot, they haven't taken advantage of this change. But I did, again, comment in the community, make sure people are aware that there was this assignment risk. I now realize, actually, if we look at this position, so this is EEM. Our short strike is here at, the 44.50. If we go to the one, we actually still have that position open in the comparative bot that doesn't have that logic applied. Again, there's the 44.50 EEM expiration August 3rd. So now we're actually at the point where we need to exit this position because we are 4 days to expiration, right? This should have closed yesterday, but it didn't close. And you can see the price of EEM closed at 42.22. Our break even, look, wow, it's $2 above at exactly 44.22. So exactly $2 away. I mean, no chance that this is going to recover. You can see this has just continued to go downhill, and now we're showing worse than our max loss. It's just because we've got really illiquid options here. So this is when that second layer effect, right? So we had a flaw in our strategy, right? We didn't recognize the risk of assignment. So the failure to address that meant that we let positions go very deep in the money, which resulted in us having this risk of assignment. But it also resulted in our positions becoming very, very illiquid and hard to exit. And by the downstream effect of that, right, that failure to exit early when we recognize a risk of assignment means that, well, if we don't get assigned, then actually we're going to be stuck with this position. We're going to be stuck with an illiquid position. And just even looking at, so where's our long strike here at 43.50? We're probably going to find that one is that's probably the one that has no liquidity. 43.50. Yeah, like volume yesterday, when we were trying to exit this position, again, this is paper account, so it might have exited, but again, it shows you actually the paper logic is smart enough to know that this position can't be exited. But one contract was actually traded yesterday for puts. Where is our 42.50? Yeah, one contract at the 42.50 strike. Oh no, we were 44. So actually, it's our short strike is the furthest out of the money. So it's our short strike is 0. So the paper trading system recognizes that we had no puts traded for our strike, so it's not going to get us out of that position, just like exactly what would happen in our live account. Most likely we're going to be held to expiration, and then just like our assignment risk, right, we're going to have an exercise and assignment on both of our strikes if we hold this to expiration. So again, one failure to fix one problem actually creates another problem. So the actual solution here is to fix this, to exit these positions early, and to again fix two problems with one change. I didn't realize the second problem was there until I actually analyzed it and tested it. Again, I've done all of the testing to make sure that I'm comfortable with it. Again, I apologize for the delay in getting this change out there, but I wanted to make sure that, again, I had some comparative results and I really understood exactly what it's doing. And like I said here, it's not just about making sure that the change works, right? The logic is correct. I want to make sure it has no negative consequences on the underlying strategy. That everything still aligns with the original principle and original intent of the strategy. And I believe that to be true, and I also believe that all of the exit logic in terms of what it's using for smart pricing and everything is appropriate for exiting these positions that are again going to be facing sort of liquidity challenges. So that fix is going to get rolled out, so that will free me up to work on my new enhancements. And so I am going to create a branch from this one and kind of diverge slightly from the Worldly Fifth Breed. So the new bot is going to use the exact same symbols. I mean, it is basically a descendant of the Worldly Fifth Breed. It has the exact same trade setup here. So very, very simple. Again, the design principle here of being everything is very simple and efficient. I'm going to be basically what's going to change is really the indicators that it's using. Trade setup all identical. The monitor, that's just directly inherited from the latest update to the Worldly Fifth Breed that has that risk of assignment logic into it. What's going to be new is the use of webhooks, and I think this is where it will diverge, just because I think this may generate a lot of other interest around just how webhooks work, and so I just maybe didn't want to conflict the two. Although I don't think I'm diverging too far from the original concept of just keep it simple. I mean, you can see here we've just really added one additional automation for the webhook here, and another automation to kind of reset the indicators at the end of the day. So really just two new automations, and you can see how simple they are. We've got just attaching a tag to the symbol and resetting those tags at the end of the day. And of course, that tag will be used in our decision logic to enter trades. So if you're a fan of the Worldly Fifth Breed, by all means, look for a new update there, and stay tuned for a further evolution of that strategy.